A very good afternoon, good morning. Welcome to HYCM's Look Ahead webinar. On this webinar, we'll be looking ahead to the key events that are due this week, and we will be seeing what the major events we need to look for and the major shifts that could potentially provide some opportunities in our trading scenarios. So I'm just going to make sure you can hear my voice and see my screen okay. So if you could just say hello in the chat box or the question box. Yes, good afternoon, Jaban. Very warm welcome to you. Please do make sure that you use the chat function. And if you have any questions as we're going through the webinar, please do make sure that you say hello or ask a question. Don't be unsure of anything. Make sure you're understanding. Yes, hello, Max. Good to be there. Thank you very much for typing into the box. I assume that you're hearing me and everything's coming through clear and okay. Right, let's get stuck in to the webinar without further ado. So that's great, Max, thank you. Now what I wanted to do is I want to just outline where we are at the moment with major currencies. So the market this morning is now quite mixed. The sentiment has been poor last week, particularly over the Evergrande challenge and the pullback we saw in equity futures markets. And there's also an energy challenge in markets, particularly in Europe, with natural gas prices moving very high, petrol shortages in the UK. So the market is in a tentative frame of mind. Now, we need to see what's been happening with the US dollar. And the US dollar is a very interesting story at the moment. Now, the first thing to realize, the US dollar has been rising, particularly from September the 22nd. We saw the US dollar pushing above that 93.50 region on the news that the Federal Reserve are going to be cutting their asset purchases at a quicker pace. That's the plan. Jerome Powell wants to see it finished by the middle of next year, and as long as the economic recovery is on track for that, then that's the expectations. That's resulted in the dot plot shift, moving higher interest rates are now expected sooner. Asset purchases are expected to be tapered at a faster rate. All of that has supported the dollar. Now, we do have a weak bullish bias for the dollar, but there is a little bit of a problem for the dollar at the moment, and I'll explain what it is. Now, the broad picture is, if we just have a look here, you can see this is the daily number of COVID cases. Now, when COVID cases, and this is the world number, when cases rise, you have increasing restrictions and a slowdown in the global economy. But when cases fall, you have an acceleration in the global economy as restrictive measures are eased. We are currently seeing a downturn in current COVID-19 cases. Now, this means that if we see the rest of the world growing and we have inflation rising, that means the inflation trade could well be in place. Now, let me just show you something. I'm going to show you an article that I've written in the past. I can't remember where it is, so I just want to find it. Oh, here it is. It's this image will be very helpful. Okay. So this is what we're looking at. Okay. Open image in new tab. There we go. Right. Now look at this. This is called the dollar smile theory. And what you need to realize is there's two different times when the dollar rises. One, the US dollar appreciates when it outperforms the rest of the world. So when there is that sort of more bullish and hawkish Fed policies expected to rise, that's what's been appreciating the US dollar. So that's what's been leading to the dollar to appreciate recently. The dollar also appreciates if there's a US recession or synchronized global slowdown. So in other words, if the rest of the world starts looking like it's going to slowing down, risk aversion comes in, if you see yen strength, Swiss franc strength, and everyone's really frightened, you also see the US dollar gain. Now, when do you see the US dollar depreciate? You see, it's when there's synchronized global growth. That's the reflation trade. So going back now to our current COVID-19 cases, what we're seeing is we're seeing those COVID-19 cases dropping. So that means the rest of the world can start moving in towards a growth and reflation path. So what that means is we have to look at these twin pressures influencing the US dollar. Yes, we have a weak bullish sentiment, but we also have to remember that the reflation trade could result in dollar weakness. So we could be seeing some choppy action in the dollar. Now, that dollar potential weakness gives us a couple of opportunities. The first opportunity is potentially in the Aussie US dollar, okay? Now, I'll explain why that's an opportunity in the Aussie US dollar. Now, look here with me. Let's find this. Yeah, okay. Now, do you see here the largest speculative short position, and it's the largest speculative short position that has been in history, is due to all the headwinds that's been facing against the Australian dollar. Iron ore prices have been really falling. China's been slowing down. There's been rising COVID-19 cases. So there's a lot of people very short the Australian dollar. Now, don't forget that phenomenon of mean reversion. So we're not bullish on the Australian dollar, but we're expecting a bit of mean reversion. And if we start seeing that synchronized global economic recovery taking place and that builds, then it wouldn't be a surprise to see some Australian dollar upside. So look for a break higher in the Aussie US dollar, and also look for potentially break higher in the euro. And in the euro, let's just reset that chart so it looks normal again. In the euro, if we start moving back above that trend line, we could see a move back up to 118 to 119. So it's possible to go long, stops just below the low, looking for a speculative move. Just watch that trend line being retested at that 1.1675 region. That is a key resistance level. But get back above that, and it wouldn't be a surprise to see euro US dollar moving higher. So remember, yes, we have a weak bullish US dollar bias, but if the reflation trade kicks in, look for mean reversion in the Aussie US dollar and the euro US dollar. So that's two things to be aware of. With that being said, we'll start to look at the calendar. I thought it was helpful just to see some of the big picture that's going on with the US dollar. And sometimes when you've got mixed narratives, it can be tricky. But remember that US dollar smile theory? If you haven't taken a screenshot of this US dollar smile theory, you want to do it now, okay? This is a good template for understanding whether the dollar is going to be appreciating or falling, and a very helpful template to use. Good, right. Now, the first significant event we have today is the OPEC Plus meeting. This has significance for oil, and this is how it's most likely to be traded. Now, the expectations is that OPEC is going to increase production by 400,000 barrels per day. Okay, that's the expectation. Now, remember, for those of you who listen to me in Dubai, expectations are key. So that's what the market's expecting. So if OPEC do increase expectations by 400,000 barrels, increased production levels, that's not expected to be a significant move. What will be significant is the following. Say they increase production by like 800,000 barrels per day. In that case, we'd expect a short and sudden move lower in oil. Okay, so if we saw OPEC meeting, and they're meeting in the next sort of hour or so, so watch out for headlines. You know, I've got my tweet deck on, and I'll be looking for any significant tweets on that, or your news squawk. And if they increase production by more than 400,000 barrels per day, expect a sudden downside in oil. Now, if they say, well, we're not going to increase production at all, then expect significant upside in oil. So that's what we're looking for. We're looking for either more than 400,000 barrels per day for selling, or no production increase at all for buying. That is the most significant outcome, and that's essentially what we want to look at. Okay. So that is our, let's just see that, reset chart. That is our expectation. Okay, top resistance up at that 76.50. That would be a first target for buying. First target for selling would be that S1 pivot zone 74.70. Okay, so that's what to look for in oil. And that's important today, very important now. Then overnight, we have the RBA rate statement. Remember, China's on holiday now, and they're on holiday for quite some time through till Thursday. Okay, so China markets are going to be closed for the holiday. So just bear that in mind, and particularly bear that in mind with the Evergrande risk. That is a constant risk that could turn risk sentiment. And if Evergrande do default in their payments, expect upside in yen, upside in Swiss franc, upside in the dollar, downside in equities. Reserve Bank of Australia are meeting early on Tuesday morning. Now, this is very, very interesting. There's not much expected from the RBA. The last moves from the Reserve Bank of Australia have been, they're not expecting to raise interest rates till 2024. I showed you how short the market is in the Australian dollar. You just, look at that. Look at that short bias, very, very high here. Look at that, very short. So the risk here is if the Reserve Bank of Australia are more hawkish, there's a risk of upside in the Aussie. So what you want to look for is potentially Aussie US dollar upside out of a more hawkish RBA. So look for signs in the rate statement, things like an improvement. I will be posting this on my blog, and I will be making making it clear, okay, what goes on with the RBA rate statement. Don't forget you can follow me on my blog here. Just go to blog.hycmlab.com, and under the market fundamentals, I have a central bank watch, and I'll be writing that up tomorrow. It should be published for Wednesday. Okay, so do check that out. You can see the central bank overview. And in the central bank overview, you can see I outline what's going on with the Australian dollar. And as I've been saying, watch for mean reversion. Yeah, these shorts are looking very stretched. So one key thing is if the RBA are more hawkish, look for some mean reversion in the Australian dollar. That's the key aspect to look for. Now, for the rest of the week, we have ISM services PMI, not likely to be that influential for the US. The next big decision is the RBNZ rate statement. That is arguably the best opportunity for the week. So let's just run through that. Now, with the RBNZ, I was quite bullish the New Zealand dollar, but I'm sort of more neutral now. At the last interest rate decision, there was a sudden shock, and the COVID-19 cases all of a sudden returned to New Zealand, and the RBNZ decided that they weren't going to respond to the COVID-19 cases. Well, they were going to respond to the COVID-19 cases, and they didn't raise interest rates. They were expected to, but didn't. And that was a bit of a shock. So now the expectations are for the RBNZ to raise interest rates by 25 basis points. And then we had very hawkish comments after the meeting, with RBNZ's hawks noting the bank was contemplating hiking rates by 50 points in August. Okay, so yes, there was a bias for New Zealand dollar upside, but what we need to look out for is some of that optimism has been curbed, with Hawksby saying that the next policy rate is more likely to be 25 basis points. So this is what you want to look for. Okay, it's this outlook. If there is a 50 basis point hike, look for New Zealand dollar Japanese yen upside. If it's if the current energy challenge bank's more concerned about CPI, then that's upside as well. So in other words, if inflation is really worrying the RBNZ, expect New Zealand dollar Japanese yen to move higher, because it will mean they'll have to raise interest rates sooner. And if they're talking down challenges, we're not too worried about the virus, we're going to manage that, vaccinations are on the rise, we're going to learn to live with the virus, and China's not a massive problem, upbeat about domestic data, all that's bullish for the New Zealand dollar. So look for that. That 50 basis points hike, now this is what you want to look for, okay? Like, so New Zealand dollar yen, New Zealand dollar, if you tested that, retested this level, New Zealand dollar, Swiss franc, New Zealand dollar, Japanese yen would be very bullish if we got 50 basis points hike. This is how to trade it, okay? So I'll just go to here, right? This is Aussie New Zealand dollar. If it's very hawkish, expect the Aussie New Zealand dollar to move down about 100 points straight off, okay? So if the RBNZ raise interest rates by 50 basis points, expect this to fall about 100 points. And all you do is just before the meeting, just sell on stop at about 1.0435, and you just have a sell on stop order just in place, about 30 points away from price, and then you'd expect about a 100-point move. Okay, so watch out for that in the Australian New Zealand dollar, ultimately expecting a test down at 1.0340. So that is a very key kind of region to be looking at and is very important. Now, another little potential trade I'd like to talk about is China's A50. Do you see how far the China A50 has fallen since the highs at the start of the year? Look, all the way down underneath that 200 exponential moving average, right? If we see a break higher at this, that will be a great trigger to go long, okay? Because we are expecting the Chinese equity markets to recover eventually, and this pullback there's often pullbacks in China's equity markets due to policy shifts. Now, if this shift towards common prosperity is stronger than the market expecting, and China pivots back towards socialism, firmly, then we could see some more downside. But otherwise, get above, stay above, keep your stops below the trend line, and go with the move higher. That would make sense. And the way you limit your risk is as long as you're above that trend line, you stay long. You move back below that trend line, you exit. But that's a good way of potentially looking of getting back into the uptrend on the China A50. So watch out for that. That's an aside point. But obviously, if Evergrande collapsed, then that would invalidate that outlook for now. So then we have the ADP non-farm employment change. Now, what we want to look out for the ADP is it sets the mood for the non-farm payroll on Friday. Okay. Now, if the ADP is strong, that raises expectations, and it raises expectations that there will be a good jobs number. Now, the ADP jobs number is not very good at predicting the NFP jobs number, but it does set the mood. So if ADP jobs comes in strong, that raises expectations for a good jobs number. Now, the good jobs number is we'll come to that in a minute, but just look out for that for setting the mood. Not necessarily a massively tradable one, but could impact sentiment. We also have Governor Macklem speaking to the Bank of Canada. Watch out for that. If you need a quick update on what's going on with the Bank of Canada, just go along here, go to my major central bank rundown, and you can see an update here from the Central Bank of Canada, and you can see everything that's going on. So look for concerns about inflation being more than transitory. And if the inflation is seen to be more than transitory, look for US dollar CAD downside, okay? CAD should remain supported against weaker currencies, and any deeper lower should offer good value near terms on CAD yen. So that's what I was looking for, CAD yen long. And don't forget, stronger oil supports the CAD. About 70% of all Canadian exports are oil related, and Canada's top export is crude petroleum at over $66 billion, and around 15.5% of Canada's total exports. So Canada, alongside the Norwegian krona and the Russian ruble, is a petro currency. So don't forget that fact. Okay, heading towards the Friday, that's the most significant event for me this week, is likely to be the non-farm payroll. Now, we looked at this in Dubai, and we'll just have a quick refresher on this, okay, and how to trade this. Now, remember the separate components of non-farm payroll. The headline, there's two surveys to get the non-farm payroll. There's a private survey, and there's a that the government conduct, and then there's direct surveys from companies, and the headline comes from the direct surveys from companies. Participation rate, that comes from the private survey of about 60,000 households. And from that, you see how many people are available to work. When that rises, that's good for the economy. When it falls, it's bad for the economy. The unemployment rate, that too comes from the private household data. And that tells us how many people are unemployed. The lower that is, the better it is, the higher it is, the worse it is. The headline print will be in key focus. Now, the last Fed rate statement said that sufficient progress had been pretty much met, and Powell just said, I just need one decent jobs report with a good headline. That's all that's needed. So most people are expecting that to happen. So the best opportunity for this is if it doesn't. So look, there's the jobs, there's the pre-COVID jobs. We've still got, 5 million jobs odd to reach. So we are still some way away, but the Fed's taking confidence that the trend is in the right direction. And we looked at that symmetrical triangle breakout, took profit in that 112 region. We still have an upside bias on the Fed shift. So looking for potential gains. 10-year yields moved higher, and we looked at the impact on gold. Now it's the impact in gold I want to show you. Notice when real yields rise and the dollar rises, that forces gold lower. Gold is being pushed lower as the real yields rise. Now what's real yields? That's the US 10-year yields minus inflation expectations. So when the real yields are going up, it's better for the dollar, and that lifts the dollar yen, but that's a headwind for gold. Now, if the jobs print misses the minimum expectations, so minimum expectations, let's just have a quick look at what they are. You can see expectations are for 490,000. So say it comes in about like 100,000 print. Then that will be a big shift. We expect the dollar to weaken and expect gold upside. Now, I really, really do like gold technically for upside, and I just would like a really weak jobs report to confirm that. So what you'd be looking for here is a weak jobs report. I expect gold to move up to 1830 as a first test, and then back up to 1900 as a second. Okay, so we're looking at 1830 as a first test, 1900 as a second. But it needs to be a weak jobs report, maybe less than 100,000. And if we saw the participation rate go lower and unemployment going higher, that would be all more supportive of gold going forward. Let's just see if I can put in the real yields into this. No, it's not liking that. Okay, I'll just show you the real yields chart. Just get rid of the tips. So this is real yields, okay, in the gold, you see. And when real yields rises up, that pushes gold lower. When real yields fall, that helps gold higher. So with real yields pushing up, that's been pushing gold low. Now, if real yields fall back down, then expect gold to rise higher. Okay, that's what we're potentially looking for. And that would happen on a weak jobs report. Also, if we saw risk sentiment really turn sour, then we'd expect the bid to come back into bonds. That would push the US government bonds down, and then will push real yields lower as well. So there is opportunity for gold, but you need to be nimble and clever. So key thing for gold is waiting for that Friday decision, waiting for the non-farm employment level, and if that comes in 100,000 or lower, then expect immediate upside in gold. That, friends, is the key things to be looking at this week. So OPEC decision due shortly, RBA rate statement overnight, RBNZ on Wednesday, Governor Macklem, always worth just popping in to see what he's saying. Look out for inflation concerns that result in immediate US dollar CAD downside. And then NFP looking for the headline to be below 100,000. If it's just a good number or higher, I'm not expecting necessarily a very strong reaction, not obviously, but a very weak print would mean that Jerome Powell might be concerned and say, actually, you know, the jobs market is a concern, so we will taper more slowly, or we won't taper at all. Yeah, you're welcome, Max. I'm glad you enjoyed it. Folks, I hope that's been helpful. If you have a question, please do pop it into the question box now, the chat. Very important that you keep on top of these points. Make sure that you drop into my blog and always look at the Central Bank Watch. I keep this up to date, folks, right? So I keep this up to date, you know, what's happening, what the central banks are doing, and by staying on top of the central bank policy, that really helps with your analysis. It really does, okay? So look out for that. Good, that's super, Yo. I'm glad that helped. Right, super. Thank you all very much. Don't forget, Wednesday, I do another webinar and we'll be dissecting what's happened with the RBA together, and I'll be outlining that. So I'll be going through an analysis there. And the idea is in time, you know, for those of you who are new to this, you can do this yourself. And that's the heart of this webinar, is to show folks how to understand the financial markets. Take care, everyone, and look forward to seeing you on Wednesday. Thank you all very much. Thank you, Max. Thank you, Yara, Richard, Kingsley. Good to have you. Josh, Alexandro, Mohsen, Nadeo, anyone I saw in Dubai last week. Thank you very much for attending my workshops and my seminars. Thank you, Richard, Vladimir. Take care, everyone. Goodbye.